How does correlation affect delta-neutral strategies? Have you ever wondered how correlation impacts delta-neutral strategies in options trading? Understanding this relationship can help you navigate the complexities of the market. Delta-neutral strategies aim to balance positions in options and their underlying assets to achieve a net delta of zero. This means that small price movements in the underlying stock do not affect the overall position. But how does correlation come into play? First, let's talk about hedging accuracy. Delta-neutral strategies often involve holding both options and shares of the underlying stock. If the correlation between the option's underlying asset and the hedging instrument changes, the hedge may become less effective. When the correlation is not perfect, the offsetting positions may not move in exact opposition. This can lead to a shift away from zero delta, exposing the portfolio to directional risk. Next, consider rebalancing frequency and costs. Since correlation can fluctuate, delta-neutral positions requiring frequent monitoring and adjustments. If correlation changes, you may need to rebalance more often, which can increase transaction costs. These costs can eat into the profitability of your strategy, so it is essential to keep an eye on correlation trends. Now, let's discuss the interaction between volatility and correlation. Delta-neutral strategies are often used to profit from changes in implied volatility rather than price direction. However, if correlation is low or unstable, it can complicate how volatility changes in the underlying asset affect the option's price. This makes it harder to predict how the option and hedge will move relative to each other. In more complex delta-neutral strategies, such as pairs trading or index arbitrage, correlation becomes even more critical. These strategies relying on stable relationships between asset prices. If correlations weaken, the assumptions behind delta neutrality may fail, leading to unexpected losses. Finally, practical application is vital. When implementing delta-neutral strategies, traders must consider the correlation between the underlying stock and any hedging instruments. For instance, using stock shares to hedge options on that stock assumes a correlation close to 1. If you use related stocks or exchange-traded funds, the correlation may not be perfect. This requires more sophisticated modeling and risk controls. In summary, correlation significantly influences delta-neutral strategies by affecting hedging precision, rebalancing frequency, and the ability to isolate volatility risk. Maintaining a stable and high correlation between the underlying asset and hedging instruments is essential for effective delta neutrality. When correlation fluctuates, traders must adjust their strategies to manage risk and preserve neutrality.